Hey, it's Richard with Matthews Wealth Management. We are doing the March 2023 market update. This is for asset class performances. So March in general was good. We're going to cover what exactly that looks like. So diving right in here, we're going to go through NASDAQ. This is the same order we always do things. NASDAQ, if you recall last time, it was kind of down here. So a huge bounce in NASDAQ, and that's growth companies, if you remember. There's reasons why that's the case, and we'll get to it here. But we've had an interesting year to start. As up in January, down in February, back up here into March, and here's where we are today in April. Almost halfway through April, so I'm a little bit early, I guess, based on the track record here lately. You can see S&P 500 here doing the same thing, up in January, down in February, and back up in March. And so overall, it's an equity. Equities are up, bonds are up, everything's up. What does that sound like? You'll see that in this one, or potentially the M2 money supply that we cover next. So just an overall moderate portfolio, right? So we're dealing with kind of a mix of stocks and bonds here. 1 year return. Actually, I meant to do year to date. Whoops. That's what I get for rushing to hurry up and get this done. But we can kind of see from January here, you've got up, down, up again. And I've got the numbers at the end for year to date, end of March, which is what this is supposed to be. But you can kind of see what's happened here in April. So sorry about that. I do make mistakes on this. And I don't know if people catch them very often, but there have been a couple here. So let's dive into U.S. equities specifically and see how they've done. If you recall, the way we're doing this is the top number represents the last month, so the month of March. And then we've got year to date as the bottom number. And they've been kind of all over the place, all right? We saw in February negative and a positive, right? And so now things are starting to really stand out. And we're seeing how things are changing as we go across this. And if you recall from the February, I did that video right around the SVB, Silicon Valley Bank, and Signature Bank, the bank runs, the collapses, the BTFP, and go check out that video if you want to know what's going on there. But we can see, we'll start in large cap, right? So 0.537, 0.317, right? So large cap growth, hint, hint. That's the NASDAQ piece of this, right? If we get into mids and smalls on the month, the only thing that's up is mid-cap growth, which is not good, right? If you recall from 2021 and 2022, what that actually means, you'll see it here. Actually, on the next video, on the balance sheet in M2. Small banks, small value, I just gave it away. Banking, right? We've had major issues in regional banks and smaller banks. And you can see year-to-date negatives right here in the mid-value and small value world banks. So, man, 17, 10, and 10. That's telling you just throw your money back in the fad stuff again. That's Apple, Amazon, Tesla, all that good stuff. So, all right, equities, we're good. Let's move on to bonds. Oh, got the other equities here. International is up. Emerging markets is up. Kind of in the right mix here. But the volatility that we saw back previously in January and February is the difference between the 4 and the 8.5. But everything's up. You know what that means, I hope. All right, bonds, everything's up. That's the point here. So short-term bonds, basically, all of their gains year to date happened in March. It's the best way to look at that. Same thing with intermediate terms. Long terms are slightly ahead, which is shocking and surprising. However, I think there's an obvious reason towards the end of March, currently through April, exactly why this long-term bonds is doing so well. Tips, majority of the gains have been just in March, and high yields actually started to drop down, and I think that comes back to people looking at premium pricing on yields, and that's the gist of all of this. If you're a client, if I've talked to you, the big picture of what we've been trying to do this year is dollar cost average from our short-term exposure into our long-term exposure and minimize our high yield exposure, just because there's a lot of credit risk out there that's not properly evaluated, in my opinion. So Looking at balance sheets of corporates, it's kind of terrifying out there. So let's get into the treasuries. And if we get to a point where the Fed pauses or cuts rates, there's going to be a premium on long-term decent yield bonds, which has been the opportunity here since December. Dollar cost average in long-term bonds. I'm sure you're sick of it by now, but it's proving to be good. And I won't give away April, but yesterday was something. All righty, so let's dive into the commodities. Oil is still selling off. Oil has rallied, and if you notice the gas prices, they're starting to go up. But it's a little surprising. I do know that we've hit the bottom again on our strategic petroleum reserve releases, and so refilling those. There was an article about how we missed our sweet spot of being able to refill, and so oil's incrementally starting to come back up. I think on the overall trend here, there's OPEC cuts, there's Russian, Ukraine, all that fun stuff going on, but watch out for oil. Watch out for gas prices. Watch out for inflation to rear its ugly head again, despite what we saw yesterday. Gold. Wow. This is the story, right? Banks, bank runs. I want my money. What is money? Bitcoin has taken off as well. Maybe I should throw Bitcoin in here. It's not a commodity. It's not a currency. It's a technology. So that's why it runs with NASDAQ and large cap growth. But 17.5 year to date on oil. Is that right? Is that legitimate? I think so. But the markets are different the way that those are run. So yay, that's good. We actually changed our commodities focus, if you recall, from energy and oil exposure more into the gold and precious metals exposure. Kind of flipped our focus there. Real estate down 2, still up 1. Yeah, rates, right? It's all about rates and yields. Honestly, yields are another big issue there. So bottom line here, NASDAQ. This is through the end of March, up 17, S&P 7.5, moderate 4.5, and we're 2 3/4. Blech. We have a lot of cash, y'all. I was like, what in the world? What's up with that? And I went back and I looked at the X-ray on our practice. I was like, oh yeah, that's why. Duh, it makes sense. But yeah, I'm trying to preserve some value. I think we're in for some rocky times. It's hard to pick out what the winners are going to be or what the losers are going to be. But overall, the debt ceiling's coming up. We've got some credit crunch issues where the Fed's actually saying that that's a reason why they're not raising the 50 basis points in March. And then we'll see what May holds. CPI came in really low and and that gives more of a reason to pause. And so that pause, stimulus, rate cuts, money supply growth, NASDAQ, growth stocks, that's just where the money rolls. So we'll see how this continues, and starting client meetings next week. Oh my gosh, and it's Thursday now. So yeah, I'll be seeing y'all soon. So that is the gist of asset class performance for the month of March and a little bit of April. And come check out our next video that we're going to shoot right now.